Okay, Accounting 2 kiddos, we are on chapter 22, which is technically the ending of a fiscal period for us with our merchandising business that we have been working on since the start of the school year. So some of this is going to be familiar because we've done closings for a corporation before, but we also have to add in some of the things we've learned starting in chapter 18. So as we go through, you might be like, yes, I know that. That's good. That's a good indicator that you remembered some stuff from Accounting 1. If you don't, that's okay. I tell you where you can go back and look what chapters you need if you need some reference. So 21 or 22-1 is talking about getting started with our end of fiscal period work. We know that the end of a fiscal period is very busy for a corporation, so they try to do it in a time frame where it's kind of a lull or a low point in their business. I always give the example that if it's retail, typically they're doing it sometime in the summer, so it's not over their busy holiday season. That would just be really chaotic for them. If you were, say, a landscaping business, you probably are going to do your fiscal end in the middle of winter when you aren't out landscaping. So it just depends on what kind of business you have and the time of year that's the least busy for you. So when we do end of fiscal period work, we have to start with our unadjusted trial balance. We start there and make sure that our debits equal our credits in our general ledger. And then we use our unadjusted trial balance to plan and record our adjusting entries. After we do adjusting entries, we post those and we do an adjusted trial balance. And eventually we use those adjusted trial balance numbers to make our financial statements. So 22-1 is about doing our adjusting entries. These are all of the accounts we have. If you look at them, it seems kind of crazy that we have talked about all of these different accounts already in Accounting 1 and Accounting 2. So there are lots of them listed here. Obviously, when we total them, we want to make sure over here that they equal. If not, we have an error either in our journal or in our ledger. So we would need to go and find those. As a reminder, we know that some general ledger accounts have to be brought up to date before we can do financial statements. So after we've done the unadjusted trial balance, we go ahead and look for our adjusting entries that need to be journalized in the general journal and then eventually posted to our general ledger. Now, there are two methods that are used to determine the amounts of an adjustment. For some accounts, the calculated estimate of that account is also the amount we use for the adjustment. So anytime when we're doing interest income, depreciation expense, or interest expense, when we calculate that, that's actually the amount of our adjustment. Other times, it requires us to estimate the end of the period balance, and then we take the current balance and subtract it from our estimate, and that difference is actually the amount of the adjustment. That happens on things like uncollectible accounts expense, merchandise inventory, supplies, prepaid insurance, and federal income tax expense. So if you remember in Accounting 1, when we did adjusting entries, we only had supplies and prepaid insurance. Now we have all of the ones we just listed, which turns out to be like 7 or 8. So we have a few more adjusting entries that we need to take care of. So let's talk about the adjusting entry for uncollectible accounts and merchandise inventory first. Our company is Sun Treasures, and they estimate that about $2,100 of its accounts receivable are not going to be collected that year. And on December 31st, the balance in our allowance for uncollectible accounts is actually $675.56. So what we do is we take that $2,099.25 and we subtract out the $675.56, and we get an amount for an adjustment of $1,423.69. So again, this is a situation where we needed to take our desired balance, take out the current balance, and then the difference between those two is actually the adjustment. Now, the merchandise inventory adjusting entry requires a little bit more thinking because we have to recognize whether the current balance in merchandise inventory is more than the actual inventory on hand, or if it's reversed. In this situation, it says that the current balance in merchandise inventory account is more than the actual inventory on hand at the end of the period. Now, when we do merchandise inventory adjustment, we use our income summary, and that gets debited and merchandise inventory gets credited. So again, the difference between these two here, which is $23,620, actually ends up being the amount of the adjustment. So income summary gets debited, merchandise inventory gets credited. Now, on the flip side, if the current balance in merchandise inventory is less than the actual inventory on hand, we flip-flop that transaction, and what happens is income summary would be credited and merchandise inventory would be debited. So you do have to recognize which one is larger, and that will affect the adjusting entry for merchandise inventory. Okay. So here it just starts off. Remember, there are no document numbers for adjusting entries. We just put the title, adjusting entries, on the first account title line. These are all done on the last day of the fiscal period. So for them, it's December 31st, and they're done in the general ledger. Now, they do talk about supplies and prepaid insurance. Those still get an adjusting entry. Those are found in Chapter 6 in Accounting 1 if you don't remember how to do those. Essentially, a balance is listed for each one on the trial balance. And then when we do inventory, an amount on hand is actually found, and the difference between those two numbers is what ends up making our adjustment. So you can see here we have store supplies and prepaid insurance. There's nothing in insurance expense or supplies expense because we haven't done the adjustment yet. When we do, supplies expense and insurance expense will have balances when we go to do our financial statements. Now, the federal income tax adjustment is another one of those where we've done it before. It's in Chapter 15, which is again in Accounting 1. The first step that we have to do is to calculate our corporation's net income before federal income tax expense. They give us Sun Treasury net income, which is $109,595.43. And then what we have to use is the tax tables that are given to us by the IRS. So we look at this tax table and we see that 109,000 falls right in here. Okay. So 109 is between these two. So what we need to do is we need to take the amount that's over 100,000. So we take 100,000 minus 109 and we get 9,595.43. Okay. That amount we end up multiplying by this 39%. Okay. So you can see that 39,000 or 39% times 9,500 equals 3,742. We add that to the tax base, which is $22,250. So those two added together is the total amount of tax that our corporation owes for the past year. So $25,992.22. Then we have to look at how much have we actually paid already. Okay, we've already paid $23,000. That's going to be found in our unadjusted trial balance. So we owe this much. We paid this much. So our accrued federal income tax expense that we still owe is $2,992.22, and that is the adjustment for our federal income tax expense. Okay. Again, that one is covered more in depth in Chapter 15, so if you need to go and review that, you certainly can. So here are all of our adjusting entries listed. The uncollectible accounts expense we went over. Interest receivable is the one where you just calculate it based on how many months we've had that. Income summary we went over. Supplies, insurance, depreciation expense, again, we calculate for that for however much we have in that year. Interest expense is the same thing. Unearned rent income, we talked about that one, and then our federal income tax expense, the one we just covered. So a total of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 adjusting entries. My goodness. After we have posted those then, we have our adjusted trial balance. Notice that some of those expenses that didn't have things before, like insurance expense, supplies expense, those ones now have updated balances, as well as the other accounts that were affected with our adjusting entries. So we're going to head over to 22-1 work together. The work together are going to be a little bit longer this time, so there'll probably be a couple of videos to go through because there's a lot of content to get through when we're talking about um, closing entries, or excuse me, the closing of our fiscal period.